We'll probably start here. Thank you, everybody, for joining us. This is Understanding and Managing Credit. I know everybody's got busy lives, so we really appreciate you joining us tonight. Uh, my name is Brad. I actually live up in Grand Rapids, up north. I've actually been in Affinity Plus for about 19 years now. I work for a consumer phone lending team, so do a lot of car loans, credit cards, personal consolidation loans, pretty much anything that's not real estate related. I can help. If you call on the phone, you might get me or you might get one of my coworkers here, Alicia. So Alicia's going to be our moderator tonight. So Alicia, if you want to say hi and tell us a little bit about yourself.
Hi, I have been with Affinity Plus for about 7.5 years. Started as a teller and worked my way up to the phone lending team. Um, I just love Affinity Plus and its culture, so I hope that you get a lot out of this webinar.
Well, again, thank you, Alicia, for being our moderator. And as she mentioned before, if you do have a question, please put it in the chat. Periodically, we might be stopping to answer some of those questions. Alicia's going to kind of monitor those and try to get my attention because I don't really see the chat. So she'll feel free to put any questions in there and hopefully we can answer them. If we can't, we're going to do some research and get back to you and do our best. So we don't want to give you a raw answer, but we have quite a bit of experience with credit, but there's always something that comes up. Sometimes we don't know. So again, feel free to put those questions in there. And again, we appreciate you joining us. So we're going to talk a little bit tonight about understanding and managing credit. And hopefully you can all see my slideshow. Does it? You can see that, Alicia, still?
Yep,
All
it
right,
looks great.
perfect. Yeah, so we're going to talk about four main points tonight. We're going to talk about the types of credit that's used, which is installment and revolving, the two basic kinds. We're going to talk a little bit about credit reports, how credit scores affect the cost of credit or borrowing, how those things can affect that, as you may or may not know. Thirdly, we're going to identify ways that you can build, and then once you have your credit built, hopefully maintain it. And then four, also talk a little bit about how important it is to continually monitor our credit accounts and reports. So credit basics, getting into credit. So credit's a way to buy things without having to pay for it all at once. Maybe it's groceries, maybe using a credit card, or maybe it's buying a car or a home. I don't know about you, but very few people, and I know myself, I wouldn't be able to buy a car or a home with just cash. If I did, it would not be a very nice car, nice home. It wouldn't be very reliable. So having credit allows us to have something now that we will pay for over time. As a matter of fact, some people will save their whole lives, but just think about if you were to buy a home and you waited your whole life to save up for that home. Well, by the time you get enough money, the home probably would be so expensive. So it gives us a way of buying something now that's of good quality and paying back, you know, Affinity Plus or whoever the lender is. Now, credit can cost different. It can cost one person so much to borrow, have a loan, and someone a little bit more. And that has to do with the interest rate and the other terms, how long of a loan it is, how well you've managed your credit in the past, what your score is. And that is one of the things here at Affinity Plus and pretty much every lender, they'll use your credit report. Very few places do not pull credit, just about everybody does. And that will determine really what your credit worthiness is and how much you might pay to borrow that. So credit, we have our types of credit. So again, as we mentioned, basically there's two different kinds. You have your installment and you have your revolving credit. So let's talk a little bit about that. So installment credit, what is that? Well, installment is borrowing a fixed amount and repaying it according to a certain payment or payment schedule. This would be like maybe your home mortgage, an auto loan, student loan, but it can even be personal loans and things like that too. So what happens is you say, I need to borrow so much for maybe this house or this car. So we will put that amount into an amortization calculator, or maybe it's the software, the lending software that we use, and it will tell you if you borrow 20,000, for instance, for 5 years for this car, you're going to have to pay exactly this much to pay it off in that time. So secured loans can be really nice, or installment loans can be really nice, especially if you know how much you need to borrow. It's not open-ended. So you have one goal to borrow that amount of money to pay for something, and you know what your payment's going to be, and it shouldn't change. Usually that's a fixed rate that you can depend on your payment staying the same. Now, with those installment loans, there's what's known as a secured loan. Now, a secured loan means that you're using collateral to secure the loan. So in other words, like for a car or a house, if you buy those things and you take out a car loan or a house loan, you would use the home or the car as collateral. And usually the rate's better because if worst case scenario happened, the car could be taken back or repossessed, or the home could be foreclosed on to pay off the debt or part of the loan. Now, trust me, no one wants that to happen. There's no Affinity Plus would not make any money off of that. We won't want to see that happen to our members. But that does allow you by putting that collateral up and having that car used for it or the home or something else, camper, boat, that does allow you to get a better rate and does allow us to usually approve a higher amount too. So there's three main factors that contribute to the total cost of borrowing, and that's your interest rate, your repayment term, how long you're going to take to pay it off, and then and also whether you make extra payments or pay early. That that's going to be your total cost. Now, if we look at this slide, this is a really good example of a student loan. Now, in this case, we're going to say that the student loan is at 6.9% for all these terms. So let's say you need to borrow $50,000 to go to college. Probably a good deal now, but anyway, $50,000, and you have different terms to pay back. You may choose to pay it back in 5 years, 10 years, or 20 years. Now, if you're paying only for 5 years, you're probably going to get a better interest rate too. But just for the sake of comparison, we're going to say that you're at 6.9% for any of these terms. But if you pay it back in 5 years, you're going to see that that $50,000 borrowing it, it's going to require a pretty big payment, $987. But if you can swing that payment, you're only going to pay $9,200 in interest. So borrowing that 50,000 is only going to cost you $59,000 to borrow. Now, that's quite an aggressive payment. I admit that's like a pretty nice car payment. So a lot of people will go longer, 10 years, 20 years, even longer. So let's say you pick the 10-year one and you're like, I can make that 577. It's not easy, but I can. Now, because you're paying $577 a month, it's going to take you 10 years and it's going to cost you 19,356 in interest. So it costs you more because it took a longer term, but you did have the comfort of making a little bit smaller of a payment. Now, like most people, they probably would have to spread it out as long as possible because let's face it, you probably have other loans, maybe a house or a car, credit card, things like that. So you know that you can pay $384. Now, because you're paying for such a long time, kind of like with a house, you see that $384 payment, it's actually going to cost you almost as much, $42,000 in interest to borrow that 50,000. So if you can pay something off early, you can make extra payments. That means overall you're going to pay less interest over time. Well, here's an example of like a 30-year mortgage, and we're going to compare that to a 15-year mortgage. I'll be honest with you, I kind of kicked myself a little bit. I had a short stint where we lived in Arizona and we came back and we took out a mortgage. And the difference between the 15 and the 30 was just a couple $100. And now I'm already 5 years in, and I wish I had gone with the 15. But at the time, I wanted to keep my payment low, which is normal for most people. But if you look at that comparison, again, we're going to use the same interest rate, 4.5%. But generally, your shorter term would even be a better interest rate, like 15-year might be a little better. But we're going to talk about the mortgage. Now, people talk about interest being kind of front loaded. Like if they start out a loan, they're like, I just pay interest at first. You're not really making much progress. That is kind of true because it's such a long term. So what happens again is the lender will take that mortgage amount, 100,000. They'll put it into a calculator or the lending software at 30 years, 360 payments, and they'll come back and they'll say, if you want to have that mortgage paid off, In 30 years, you're going to pay exactly 506.69 for the next 30 years. So what happens? Well, at first, because that payment is amortized or scheduled over the 30 years, not a lot goes towards the principal. It goes very slowly. Why is that? Because a payment and the amount that goes on the interest and the principal is based on whatever the balance is after that payment. So if you start at $100,000 and at 4.5% interest, most of that first payment will be going towards interest and very little towards the principal, as you can see. Now, the next month, there's slightly less on the principal, so then just slightly less interest will accumulate. So it keeps on going down and down over time. But when you get to the very end, that same payment of 506.69 mostly will be going towards the principal and not the interest. So when someone starts a loan over, maybe they refinance it. If they go back out to the 30 years, they could be end up paying, even if the rate goes down a little bit, they could end up paying a lot longer. So it's something to kind of consider. So now let's compare this to the 15 year. Now again, it's going to be a little tougher. That 500 and some payment's gone up a couple $100. Now you're at 764, but you're going to have that paid off in 15 years. What happens? Well, because you're paying more at first or over the life of the loan, and it's a shorter term, even though the interest rate here says the same, you're going to be paying, see how much more of that payment goes towards interest at first and how much goes towards principal? Again, it's still going to keep going down. So as you get to the very end, almost entirely all of that will be going towards the principal, even though your payment stays the same. So it kind of is like that student loan. The shorter the term is, the more you can throw towards the principal, the less interest you're going to pay for the life of that loan. And we'll talk a little bit about some other tricks that we can do to hopefully reduce that overall interest cost. So installment loans, how can you reduce costs? One of the biggest ways that I really advocate for, and Affinity Plus does too, is to make bi-weekly payments. That can reduce up to 18% of interest of what you pay on a 30-year loan. So why is that different? Well, what it happens, let's say you're making a payment each month and it costs you $1,000. If you pay $500 every 2 weeks, what happens? Well, in some ways it's easier to pay. Just make that payment every other Friday. Maybe you're paid bi-weekly like most people are. Well, you could pay your car loan, your house, whatever it might be. You can pay every other week. And as you pay that, that will shave time off because you're making one more full payment per year. And that will go on the principal a little more quickly and also make that extra payment. Now, unfortunately, we used to be a huge advocate for this. We would always tell people, gotta make a biweekly payment on your mortgage. Well, the big companies that are in charge, Freddie Mac, Fannie Mae, they kind of took that option away, probably because they want you to pay as long as possible and make more money, make more interest. But there are some other ways that you can do that yourself, excuse me. You could um, put money into a savings. We could work with you and then make that extra payment as soon as that extra money is accumulated. So if you haven't done so already and you have a home and you want to do it that way, let us know. We'll get creative with you. Um, Highly recommend on our personal loans that, like our car loans, things like that, that if you can make a biweekly payment, great. Again, to me, every time I'm paid every other Tuesday, I take half of my car payment, I take half of my house payment, whatever I might have, my camper, and I pay that. Have it come right on my check. I don't miss it as much, and it's a lot easier than me trying to make that extra, $1,000 payment once a month rather than 500 every 2 weeks. And at the same time, I try to throw a little extra on there, and eventually you get ahead, and you could even take a couple months off if you wanted. So what is the pros and cons of having installment loans? Well, the pros of of refinancing. Let's say that the rates do drop, and you want to refinance your car at a lower rate. Well, what's the pros? Well, you might be able to have a lower monthly payment and lower the cost. The cons are, again, the interest because you're going back out to like a 5 year, let's say you had a 5 year car loan and you paid for a year and they're like, hey, rates dropped. I might as well get a better interest rate. We'll do that for you, no cost at Affinity Plus. We just have to put an application in and pull your credit. We're happy to get you that better rate. But what happens lots of times is people will go back out to that 5 years again. And now they're adding another year back on and they're paying a lot more interest. So the best thing that you could do is refinance the loan at the better rate, but also keep the term at where it's at. If you've made 12 payments on a 5 year, make it a 4 year if at all possible. I had someone do that the other day. They actually had a 7 year loan. The rate dropped so much, and they had been paying for a year that they were actually able to go to a 5 year, shave off a year, and their payment was about the same. So if they had gone back out to 7 years, it really would have defeated the purpose. They would have got a little better interest rate. That's true. Um, but it also meant that they would have been paying longer again. Now, sometimes you don't have a choice. Sometimes you have to free up some money. Maybe some cost of something went up or you had reduced hours at work. Sometimes people have come to us and we will refinance the loan, go back out to the term to get that payment lower. And we're happy to do that if that works with you. Um, you will pay longer by going back out, but sometimes that's necessary to make ends meet. So there's something else too that will cause, that installment loan on a home loan to possibly go up or down, and that's your escrow items, like your insurance, your taxes. You can roll that into your home payment, and then that can usually does go up a little bit each year, so you'll see your payment get adjusted a little. The other thing too of a cost is private mortgage insurance. Now, private mortgage insurance or PMI, you've maybe heard of it. But what that allows you to do is it allows you to buy a home without having a 20% down payment. That's pretty much what lenders want to have. They want you to have 20% down. If you don't do that, you can still have 3 or 5% down payment, but you have to carry this insurance called private mortgage insurance. It might be anywhere from 70 to $200 or more per month. And you have to carry that until you get down where you have 20% equity built into the house or you've paid down 20%. Um, it really does you no good except it allows you to buy a house without having to put 20% down. That only covers and helps the lender in case there's ever a foreclosure or something like that. So that's one thing that you can look at. Maybe you feel like your house is worth more than it was when you bought it, you can actually check with your lender and you can say, can I pay for an appraisal? If you pay for appraisal and it comes in higher, they may be able to drop that insurance or they might reduce the cost of the monthly payment or the monthly premium. Something to look at, or maybe you just pay down for a few years till you get to that point. But of course, because interest is front loaded on a mortgage, you don't pay the principal down quite as quickly. So it's something to look at. You could pay $400 or $500 for an appraisal and maybe lower your payment by a couple $100. It may be worth it to you. Well, now we're going to talk a little bit about revolving loans, revolving credit. I guess the biggest example probably is a credit card. So a credit card or maybe a home equity line of credit or even a personal line of credit, we offer all of those. What it is you just have to make a small monthly payment to pay back. So maybe you have a line or credit card of $10,000. Whatever you borrow, you usually have to pay back like 1.5% to 3% of that outstanding balance each month. So credit cards, home equity lines of credit, one advantage is the interest isn't front loaded. So any payments you make beyond the minimum are going to be applied to the debt. Um, why is this a good product to have? Well, it's nice because you would have that loan. It typically stays open. The credit card stays open for years, sometimes never closes out unless you want to. And you have the option then of only making a very small payment each month. But what happens if you only make that small payment? It might take you years, even decades to pay it back. But there might be one month that you say, I'm going to pay just a few dollars because, it's that time of year or something. Do we want to pay more another month? Well, you have that option too then. But let's look a little bit about why credit cards can kind of be a little bit of a trap with that minimum payment or even lines of credit. Here's an example. Let's say you owe 5,000 on a credit card. You go on a trip, you have a $5,000 limit, you max out the card. It's at 15.9%, which kind of a typical rate with Affinity Plus, but probably almost twice as much other places. So what would happen if you only make the minimum payment? Maybe that payment on 5,000 is only about $70 a month or something. Well, a few years ago, the government actually forced the credit card companies to put on the statement, if you only make a minimum payment, it'll take you this long to pay. So in this case, if you made the minimum payment, that $5,000 is going to cost you $10,658. And it's going to take you 17 years to pay that back. So just think, borrowing 5,000 is going to cost you twice as much in interest. So it's almost like if you went on a trip and used that card for $5,000, it's almost like you're going to pay for that trip 3 times. Why does it take so long? Well, one factor is as you pay it back, that minimum payment goes down each month. So you're just barely covering the interest and a little bit's going on the principal. Unlike an installment loan where you know if you make that payment, what's required, that minimum payment, it's going to go down and be done at that time. So what can we do to help? Well, try to not spend as much. Sometimes it means if you go on that trip that you're maybe gonna try to go a little more cheaply, go somewhere else where maybe you only owe 3,000. Also, try to pay a lot more than the minimum payment. Again, the credit card companies, they want you to pay that minimum so that you end up paying them 2, 3 times what you borrow. Um, and if you can, double up on the payment if at all possible. Maybe pay bi-weekly, like we talked about. Maybe you make half the payment every 2 weeks, or a whole payment every 2 weeks, if at all possible. And that will really help reduce that. Another thing you can do with us is you can ask. You could say, I'm going to borrow $5,000 on my credit card. My interest rate is 15.9%. I know that I want that paid back in 2 years or 18 months. We can put it in the calculator for you and say, okay, you got to pay exactly 400 and some dollars per month and don't deviate from that. Even though that minimum payment might say $70, you have to pay that much if you want it to pay it off in that amount of time. So feel free to reach out to us anytime on that. So what are our pros and cons? Well, installment credit, if you know exactly what your debt is and how much you need to borrow up front, maybe you're buying something or a car or something like that, you know that the pros are that you'll have the same payment. You know that what your interest rate is going to be, how much your payment's going to be. And they're usually a little lower, the interest rate, because it's fixed. We know that that loan is going to go away. So what are the cons of installment credit? Well, if you just make the minimum payment or the monthly payment, you're going to pay a lot more interest up front because the principal balance is more at first. So a lot of your initial payments, you won't see it go down real quickly until more halfway in or towards the end of the loan when you're really making progress on the principal. But what about revolving credit now? What are the pros of that? Well, pros are is that it can be flexible. Maybe you only want to make that minimum payment that 1 month. Um, Also, if you pay the credit card in full each month, because there's usually a grace period, we have a grace period on ours. If you pay it in full, you won't ever pay any interest. We don't have any annual fees on our credit cards. You have to be careful of that because that can cost you. But we don't have anything like that. But you do earn points. Lots of times you're in cash back. Sometimes there's some protections for traveling, things like that. If you look at our credit cards. Um, and then also when you pay the minimum, more than the minimum, right away at that time, it's going to reduce the overall principal. And that kind of works the same way with installment credit to car loans. If you pay more, it will go towards the principal, but you guys sometimes apply it right to that. What are the cons of revolving credit? Well, they usually are a lot higher of a rate because lots of times they're a variable rate too. So that means if interest rates go up by the Federal Reserve when they talk about raising rates, sometimes credit card rates will go up. Then all of a sudden you're making very little progress on paying the principal down. You're only paying the interest. Um, and it's also easy to keep using it, isn't it? That's the other thing. Even if you're making that minimum payment or and more, if you keep using it and keep maxing it out, it can be so easy to do. I think we've all been there. I know I've been there. If you have that credit there available, it's very easy to swipe, very easy to do. So can be kind of dangerous sometimes. Okay, so we're going to move on to credit reports and scores. I don't know if we had any questions yet or
We have not had any questions, but feel
okay,
free to use the chat and let us know what you're thinking.
sounds good. And we can always talk a little bit after too. Okay, so we're going to talk a little bit about the actual credit report and the actual score. So credit report here, what is a credit score? Well, we pull from TransUnion. There's actually three different credit bureaus. It's kind of confusing. Experian, Equifax, and TransUnion. And each one of those credit bureaus have different scoring models. So sometimes they weigh having late payments will really hurt you more than others. Sometimes having a home mortgage will weigh higher than another kind of loan. But generally, the credit scores range between 300 and 850. That's your credit grade. Um, we say Affinity Plus, we say 775 or higher is A++. That's really good. We see that score, you're almost always qualifying for a loan if it's affordable. And then a little bit lower than that, we say 730 to 775 is still A plus. That's great credit. 670 to 730, we call that A credit. And then it goes down a little bit from there, B, C, D, and then lower. It's a little tougher to get a loan, but not always. We try to work with you. And that just kind of gives you an idea where it might be. Um, I've done quite a few loans over the last few years, and I'd say I've seen a perfect credit score of 850, maybe 5 or 6 times, something like that. It's pretty rare. Um, that's usually because someone has a home loan or a car loan for 30 years, and they've had that history. Um, so we're going to kind of talk a little bit about factors, how we can get it as close as possible, but it's pretty unlikely to have an 850, but it does happen. Once in a while, you'll see someone and they're pretty proud of that. So um, your score can depend a little bit on that credit bureau and what kind of model they choose. So the nice thing about Affinity Plus right now is the app has the actual credit score that we pull. So it's nice because we can actually tell you if you qualify for this loan, you're probably going to get this interest rate. And it's kind of a nice tool before we pull credit. So kind of nice. How are credit scores determined? Well, there's really 4 or 5 main factors. The first one I've heard is about 35% of the weight is your payment history. So that determines about a third of what your score is going to be. And you make that payment on time. It's very important to try to make it on time. Um, if at all, even if you can't make it on time, reach out to us, please, if the loan's here. Try to make it within 30 days because then we don't have to report it late. Um, the percentage of available credit being used. So your percentage of available credit, let's say you have a $10,000 limit on a credit card. If you use the whole thing, that will adversely affect you. So if you have it maxed out, or you're using 9,000 of it, that can have an adverse effect. So we want a good rule of thumb is to try to keep it at 20, 30%. So try to keep that there if at all possible. Sometimes it'll happen, you'll go on a trip and you'll do something, use that card, you might have a little bit more. Try your best to keep that payment below 50 or that amount on the credit card at least at 50% or less of what your available is. And that should help your score go up. Also, the
Brad,
time on your accounts. Yeah,
we
go ahead.
we got a question that came in.
Sure. Want to come
What
into
is
it?
the reason for changing the credit score so often? Each month, my credit card spending changes, so the score changes. But why not wait for at least quarterly?
A good question. I guess that's what's determined by the credit bureaus. We're kind of at their mercy of how often they change it, and they do change it every month. So I think that's kind of to keep up on trends, keep up. Then we know that, or they know that if you've taken out new credit, how that's affect what your snapshot is. And I guess they've just chosen 1 month as a time. So It is true. 1 month can go up or down 20, 30 points or more I've seen. And that might have to do with 1 month you had a little more on the credit card and you didn't pay it off, and the next month you did. So that's why we give you the updated score that we see every month too. So I guess it's just kind of what credit bureaus do. There is kind of another factor with um, people that are in the military too. It's kind of a safety thing as well because um, that way you can tell more quickly that something has changed on your credit. You'll see something out there. Why did my credit go up? Why did my credit go down? Oh, there's a new trade line. It gives you a chance to get on it more quickly if there is identity theft or something like that. So and that's why they probably determine that. So, and did you have another question there? I think I saw.
Yep. So I have two revolving cards and I paid it off in full at the end of each month for both.
That's good.
Yep.
That should
And
really help
I'm
your.
thinking that that's it. I can answer this one.
Go ahead.
So the credit bureaus, they they get reported to by a deadline by every financial out there. And I think they have to report to the credit bureaus by the 15th or there's some unknown date, but we think it's around the 15th of each month. So it will depend on when you've made that payment if it's reported. So that may be what the fluctuation of that credit score is happening, is maybe one time a credit card didn't get reported on time.
I've
And
seen that happen.
unfortunately, we're at the
Mhm.
mercy of the credit bureaus. And yeah, if we could go
I've
at
seen that
them, we
happen.
would.
Yep. Yeah. Yeah. So yeah, that's a good point. So like your statement cycle, like ours are due the 7th, and they might not have reported, we might report the 7th, but then the credit bureau, right, to give you the new score on the 15th. So it just kind of depends on what the balance is at that time it's being reported. So yeah, there could be a timing issue. I've seen that happen. The good thing is usually if you pay it off, then by the next month, if you wait, it'll be back up there. So and hopefully you're not trying to apply for something right at that moment. But that's what's nice about the credit score we have online too is I've told people right out, hey, that's wait till we hit 670 if you want. Your rate's going to be 3% better. And they've done that. And they're like, hey, I hit 670. And then we'll refinance their car or they'll take out that credit card at that time. So that's a good question. So the length of credit history matters, whether you have opened something up new, and then also kind of the credit the mix too. It's auto loans, mortgages. They're usually really good loans because they're secured debt for a longer time. And having a little bit of mix, sometimes we'll tell people, you should really open up a credit card or a revolving debt because that can really help you. And again, we don't know the exact, we have a kind of an idea. If you take care of these things, your score should be good, but we don't know 100% exactly how they model things. Again, there's different scoring models, um, but if they kind of keep it a little bit of a mystery, to be honest with you, we can kind of try to play by the rules a little bit, and that will help us. But we don't have the exact calculations that they have. All right. Well, let's move on to the credit reports. Like we said, there's three different bureaus, Experian, Equifax, and TransUnion. It's nice because Affinity Plus does report to all three of them. It costs an financial institution money to report, but we do report because we want you to get the benefit of having those payments show up on all three of the reports. I used to work for a bank that only reported to Equifax. So then you go to get a loan at another bank and they pull TransUnion. They're like, well, I don't see that history of the house or the car. So it's kind of nice to have that. So the credit report does have your personal information, credit history. It shows the last address and job employer you were at when your credit was pulled by someone. And we try to look and see what that is and see if it matches up. So it's going to have your social security number, your date of birth, your current and previous address, employment history. The big thing that we look at, of course, is how much debt you have out there and how you've repaid it. It's also going to show for up to 10 years. It's going to show if you had a bankruptcy, collection, things like that, 7 to 10 years. I meant to take that any criminal issues off there because that doesn't really show up there. That's um, only if you owe money to like the IRS or something, but that would be a collection or a tax levy, things like that. So what goes into that credit report? How are we going to use it? Well, it's more than just getting a credit score. Um, as you probably know now, lenders use it, but also when you go to get a house or you go to get a rent a apartment, the landlords are pulling it now. Even employers, I know the banks I've worked at, they would pull a credit report if you want to work here because they want to see, how you've handled your finances. Insurance companies, lots of times your premium is based on that. So it's getting more and more that the industries are using the credit report. So if you have a lot of missed payments or collections, it can really affect you. But it can happen. So we want to move on and try to get ourselves in a better spot if possible. So how do you get your credit report? Well, unfortunately, the credit bureaus again, a few years ago, they do not allow us to give you a copy anymore. We used to always give a copy to our members, say, yeah, take it, look at it, print it out. Why not? We pulled it. But it's probably kind of a money making thing. They sell the information to like Credit Karma in the different places so that you have to subscribe to them. But you can get your you can go to annualcreditreport.com. That is a government service that allows you to get one free report for each of these bureaus each year. And um, if you do go to that and somehow, you know how when you click on something, it's so easy for something else to pop up. If all of a sudden they're asking for a credit card number or something, that's not the free credit report. Freecreditreport.com does not have free credit reports. You pay for it. So you want to go to annual credit report. But also, um, the app that Affinity Plus has is so nice because it has the actual score and it gives you a snapshot every month. Now, it doesn't, it will list all everything on there and stuff. It doesn't give you all the information, but it is really nice because it will show you what's out there, what your score is, and if you see that it'll tell you if your credit was pulled too. So it's a good thing to review. That's why I love the app and having that because it doesn't cost anything. It's not pulling your credit. It's just giving you a snapshot of where you're at, and then it will tell you, hey, my credit was pulled. So let's dig into the credit report. How can we understand that? Well, first thing is you want to make sure the information looks accurate. There are definitely errors that happen all the time. Um, Payments might be said that they're late. Doesn't happen that often. Usually, if it was reported late, it probably was late. But there might be an extenuating circumstance. Matter of fact, if it's a mistake that Affinity Plus makes, we always are willing to work with you to get that um, fixed on the credit report. We can't just say, okay, we're gonna just change it to an on-time payment because we legally can't do that because we have to say did they pay it on time if they didn't? Now, if it's our fault because we didn't set up the payment right or we made an error or something, then yes, we will fix it. But otherwise, we have to put what you did if you paid it and when you paid it. Um, you can dispute the information if you feel something's inaccurate, or that happens a lot now. Matter of fact, if you go to transunion.com, we just kind of stick with TransUnion, but you can go to any of the bureaus. You can dispute any transaction you think on the credit report that isn't correct. Now, what happens is it goes back to the lender or the company, and they have to prove that you really do owe that money or that you were late. And if they can't do that within 30 days, then it should be corrected. So it's so common that that's one of the main things right on the main pages of the bureaus that show, hey, do you want to dispute a transaction? Um, Minor inaccuracies, we see it all the time. Just, maybe you have a PO box and a street address. Things will come up, a little alerts and stuff, just because it's slightly different because someone typed the word number instead of putting the number sign in your address. That usually is no reason to be alarmed. But if you do see something that's not yours or you think you have identity theft, you want to reach out right away. And we certainly can help you too. So that's the big thing now. What happens when you think you have identity theft? We want to address that right away. You're going to want to contact the credit bureaus as soon as possible. You can place a freeze or a credit alert on there, and that's becoming more and more common. I finally did that myself. I don't know why I hadn't done it before, but what I did is put a freeze on the credit bureau. So that means that anytime someone wants to pull my credit, they have to call me, they have to tell me, If I go to apply for an auto loan, I have to unlock my TransUnion credit score or credit bureau. So I just simply sign onto the website, unfreeze my credit so they can pull it. And the same thing happens with Affinity Plus. I'd say probably, 1 in 10, 1 in 20 people say, oh, that's right. You go to put in a loan and their credit's frozen. That's great. That's how it's supposed to work. That means if someone gets a hold of your information and they're applying for a loan, there might be a message that says you better call the member at 612 whatever to verify that that really is them. So it's a good precaution to have. You're going to want to file a police report as well. And then, unfortunately, you're going to have to call those lenders that have on the credit and remove the account or ask them about it. So that's why it can be a lot of work. It can be daunting, but we certainly can help as much as possible. So should you lock your credit? To me, I think it's not that big of a time thing. It's a great way to deter fraudulent credit. It's a lot harder for thieves to start a new account in your name. The con is you just have to unfreeze the credit each time you go to have it pulled. So if you're applying for that credit card at Macy's or somewhere, you're going to have to unlock the credit. But to me, it's really not that big of a deal. So something to think about doing. I know I locked mine and all my family members so that when we apply, we just have to remember. And I forget to. I'm like, oh, that's right, I have it locked. So I just jump on the website and unfreeze it. So now we're going to talk a little bit about building and maintaining our credit. We want to get to that point, don't we? So how do we establish our credit? Well, opening an account. Maybe open up a credit card, a line of credit, and that's where Affinity Plus is great. None of us here have commission or quotas, so we're going to look with people, and we're going to definitely try to work with you on that. And I actually saw the question this time pop up, does it cost money to freeze a credit? And it does not. That's a free service. So you can just let them know. Doesn't cost you anything to freeze it. So good question. If you're paying like Credit Karma in those places and identity theft monitoring, of course, they have a fee, may or may not be worth it to you. But uh, we actually, with our new bundle up checking, we actually have some monitoring too. So that's something to ask about too with the bundle up checking if you don't have that. That has some monitoring built in. Um, so opening up your credit, paying your bills on time, and again, really try not to max out your available credit, like we talked about with the credit card. Um, what kind of credit card do you want to get? I can say honestly, again, not having commission or quotas, the best card I've seen around is our Classic and our Premier Select Rewards cards. They have no annual fee. The rate is as low as just about anywhere, and you get back the My Plus rewards. There's also all kinds of protections on there. Matter of fact, if you rent a car, it's going to pay for the car insurance. If you buy a electronic device, let's say a laptop, it's automatically, if you use your credit card to buy that, it's automatically going to double the warranty from the manufacturer. We work with a guy from Bemidji, and sure enough, he had a Dell laptop. Like 1 week after the warranty expired, it broke. He's like, hey, I used my credit card, my Premier card. Sure enough, Visa paid for the repairs. He got it sent in, got it fixed. So something to keep in mind. I try to always remember if I'm buying something like a TV or electronic device or something like, oh, I better use a credit card. I can always turn around and pay it off when the bill comes too. There's also the free credit monitoring a lot of credit cards have and the credit scores. Again, we have those things available too. So depends on the credit card, but I can tell you, and I'm not just saying that, people, when they find out about our card, they're like, wow, the rate's half of what 15% or 14% compared to 30 now, a lot of the cards are. No annual fee, no fee to transfer a balance from another card. So if it's something that you don't have and you want to look at it, we can see if you can qualify for the card. So how do we manage our credit? Well, it is a good idea. That gets back to that every 30 days. I know it seems like a lot of monitoring to keep up on it, but if you could look at your statements, it's very important. One of the reasons too is if there is a charge or something or a fee, um, you will have only so long to dispute charges. Um, I forget exactly. I think it might be 60 days or something. But Visa, we have to work with Visa, who does the debit cards and credit cards. They will, you can dispute it. But they don't have to give you the money back if it's been more than 60 days. So you want to always be keeping up on it, making sure if you see that there's something happening or a charge you don't, we can get you a new debit card or credit card. We want to freeze those right away. We have machines that make them right at the branches, so it's so nice. If you need a replacement, you can just drop into one of the branches and walk out with a card instead of waiting for a week or more. So that's a good way to manage and keep up on it. Another thing too, we talked about don't let things go 30 days. Um, Lots of times, the sooner you talk to someone about a problem, the sooner we can do something. If it's 3 months after you've been late, we're really limited. It's not as easy. But if you reach out to us, even before the payments due, we have sometimes members that will reach out and we're like, yeah, maybe we can do a skip a payment. Maybe we can modify to pay so you pay just the interest for a few months. Reach out to us. There are things available. We have to make sure to go through our solutions department. We call it solutions. Most companies call things it collection department, but we truly are trying to find a solution. They're a great group of people that work there. They try to work with you and we try to help. We don't want to see you struggle. It doesn't do anybody any good. We're not out there to make a bunch of fees off of you. So reach out to us. And then, of course, reviewing your credit reports annually is a good idea. But if you have the app and you're using it to check your credit, that actually is just as good, if not better, because you're getting that at least once a month or as often as once a month if you want to. How about automated bill payments? This can really help you too. I mean, how hard is it right now to keep up with all your streaming services, all your everything? Imagine if you had to pay everything um, by calling or over the phone or over the internet. It's so nice if you can have these things set up. So I really encourage people to set up the automatic payments. Matter of fact, we do for all our loans here. We encourage you to. Maybe you have your own system and you don't want to. That's fine. Some people use bill pay, but you can even schedule automatic payments for your credit card. So like always pay the minimum, and then if you wanna, so at least that payment's not missed. One time I forgot to pay my small little line of credit payment. It was 15 bucks. It was a $15 late fee. It's like, oh, that really stinks. Just $15 payment, and I have to pay a late fee of 15. So keeping up now, I have it set up as an automatic payment, so at least makes a minimum payment if my credit line kicks in. So how do you build credit over a long time? We want to maintain that credit once we get to it, don't we? So it takes a long time to build credit. And of course, as some of us know, it doesn't take long for it to go down, just a few missed payments. What are some things to do? Again, pay your bills on time. Pay them in full if you can. If you can pay that credit card payment off each month, awesome. That's not realistic for some people. It's just how it is. We know that. Um, but try to pay as much as you can and extra. Try to use 25 to 30% of your available credit. So again, if you have that credit card or that line of credit and has $1,000 limit, try not to use more than 200 to 300 each month. There could be sometimes it goes up a little bit more, or like Penny was saying with the timing, you do pay it off, but it kind of catches it before you could pay it off. Um, the big thing is just to try to not use more than 20 to 30%. And that's another thing. You can actually ask for your limit to be raised. We have people call us all the time. I just had someone today. She had just a very small credit card of $500, but she had excellent credit. And I saw that it said that we offered her credit card for 5,000. So I knew that we could raise the limit on the existing card. So I said, "Do you want to raise the limit?" And we chose 4,000, just kind of nice even amount for her. And now even though she's carrying a balance of 500, it's a small fraction of the 4,000 limit. So that can help you as well. She plans on paying it off anyway, but it gives her a little more flexibility in the future if she is spending 1,000 or 2,000. Now she's not maxing out the card or going over the limit. Another thing too is if you take out a lot of loans or have your credit pulled a lot, It can reduce your credit score a little. Each credit pull, and again, that's one of those things that the bureaus don't really tell us. Sometimes it's 2 points that will lower your score when you pull your credit. Sometimes it's five, sometimes it's more. But usually, the more you do in a 6 month period or shorter term time, the more it's going to affect your score adversely. You might go to the car dealer and they're notorious for that. They'll say, well, it doesn't really matter if I pull it all in one time. I'm going to shop you around and try to find the best rate. They'll pull it six, seven, 8 times I've seen. That will still hurt you. Not as much if it's on the same day or within a 2 week period, but it still shows up as all these inquiries. So that's something to really be aware of. And again, they're trying to probably get the most commission they can. I mean, that's somehow how they make some of their money, of course. But at Affinity Plus, we're not going to do that. We're going to have one credit pull. We're going to use that same credit pull for whatever loans you do in that 30-day period. And one of the most important things, again, if you're having any kind of trouble, please make sure to communicate with us. Let us know. We're here to help. We really do. We help people all the time, and we want to see you successful. So, what are our takeaways today? Well, in general, the longer you take to pay a loan back, the higher it's going to cost you. Second point, credit reports and scores can be used for so much more. That's why it's so important to monitor your credit and look at it because poor credit can even affect if you want to try to get a job or rent an apartment. Um, really, all aspects of life, insurance costs, identity theft. That's a big one. I'm sure we'll probably end up having a seminar or workshop just on that. It's a serious risk, and it can be kind of a nightmare for people. So the sooner you catch it, the sooner you see things happening. Look at your statements, and I guess that gets back to why probably there's a report every month. Does help us a little bit to try to keep up on things, even though it seems like it's kind of redundant doing it month after month. And remember too, building and maintaining credit's a process. We talk about it being more of a marathon. It's not a sprint. You don't go all the way to 850 and then stop. No, you're going to have to maintain it. You're going to work at it and consistently paying your bills, consistently paying your loans over time and properly using it. It's really going to pay off. It's going to get you a better rate. It's going to cost you a lot less when you borrow money. Okay. Well, thank you all so much for attending. Do we have any other questions in the chat
Yeah,
or
we had
comments?
one. We had one a little bit earlier about a renter reporting on-time payments,
I was
and
thinking of
is it
that
worth
today.
it?
I was
Yes,
thinking
it's
of that today. I don't know much about that, so I had to do a little research. But that's a good question.
absolutely.
Um,
And
does it
yep,
cost
so
you any money? I
on-time
wonder if it,
payment, I'm sorry. So if a renter is willing to report on-time payments, absolutely. On-time payments maintain that good payment history. So yes,
yeah,
absolutely worth it.
I think it'd be a good idea. Does it cost money though? I wonder about that. That's the one question I would ask.
I think that
If
would
it
be on
doesn't
the
ask,
renter though, or
yeah,
on
if it
the,
asks
yeah, yeah.
landlord. Yeah, so if they charge you money, that's something I would kind of weigh out. If like it's $50 a month, I'm like, oh, maybe there's a better way we can
Hmm.
get you like a positive credit. But if it's free, I would go for it. Yeah, absolutely. I see that. It's kind of funny. I was just thinking about that today. I was like, I don't know much about that, but um, yeah, if they'll report, I think we agree that's probably a good idea.
Yep. And then we have another one in here. How long do credit inquiries affect your credit score? I didn't realize pulling my credit um, was only for 14 days for my auto search. I was looking for a car and looked in two places, but it was just over 14 days. Is there any way I can have one deleted? My score was very good, and I'm wondering if it can be adjusted in my error.
Sure. Unfortunately, if you have the credit pulled and you did authorize it, the pull happened. However, credit score, the pull should be good for 30 days through us. Same with the dealer too. If they were pulling your credit and stuff, they should, um, if they've already pulled it to different places. The thing that might happen is they might, like I said, they might use several different lenders, so they're shopping around trying to find either the most commission for them for doing the loan or the best rate, but they might shop around, they might pull your credit several times. If it's done, it's done. It will drop off. I think like usually those inquiries, I think they'll stay out there. You can see them for like 18 months, but they're not as big of a deal the further out you get. And and it's really hard to say. That's one of those things kind of we talk about the credit bureaus being a little bit of a mystery. We don't know exactly how much they'll drop you. It has to do with how much other lending you have, how many other trade lines you have. Um, if you need a loan and you have your credit pulled, I mean, you have to do it. It's kind of one of those necessary evils. So go for it. But that's one nice thing with us is we're only going to pull it one time. Even if you end up getting a different car, I even had some members. I had someone today that they returned the car a couple days later, and then we had to take out a new loan, but it was still the same credit pull we were able to use. We just had to do a little things on the back end here. So try to limit the amount of pulls. Like if you go to a dealer or something, say, now are you pulling my credit? Um, this is the rate I can get at Affinity Plus. So unless you can tell me for sure you're going to beat that, I don't want my credit pulled. That's what we tell people. But probably start with us. We really do have your best interest in, and we get calls from all over the country right now because people are Googling our rates and saying, you guys are the best credit union for boat loans, car loans. Um, you're the second best one I found in the whole country. So we're probably going to be 2 or 3% better than the dealer could get you anyway. So it's just the fact of life. We just don't have the commission and stuff that makes it higher. So, but good question. Does that explain it?
I think so.
Okay, sure. Anything else anybody has? Any questions? Oh, and there is a QR code here. I guess I forgot about that. If you do want to scan it, you can take a short 5 question survey to help us keep helping you and improve. And also, I think someone mentioned something about having a webinar on different topic, maybe on
Yep,
identity
the
theft. That would
identity
be
theft. Yep. Yep.
that's something I need to learn more about too.
Hmm.
Honestly, exactly what to do. I've learned some things over the years, but definitely, yeah, definitely important. So if there's no more questions, thank you so much. We'll keep this up here a couple minutes so that you can click on the QR code if you want. I appreciate you joining us. And also, if anybody reaches out, feel free. Call and ask for Alicia or myself, or call our phone lenders, and we'll be we'll be really glad to help you. So,
We had another question come in.
okay, go ahead.
Many years ago, we were told by another bank at which we had accounts that they would not beat your mortgage rates. I've been with you guys since 1970s. Wow, that's awesome.
Wow, that's great. Awesome. Really appreciate
Well,
that. And
thank
that's the
you.
thing. The more our members participate, people ask, how can you have your rates so low? We're like, well, we don't have commission and stuff too, but because of our members participating and we have really strong members, the more they participate, the more you do a loan, the more that interest you pay can help us to help other people. So um, it's a good relationship. I worked at a community bank and there was a big difference. I mean, you were paying shareholders, board of directors, where our board of directors don't earn anything. We don't have shareholders. So yeah.
Hmm.
But if you call our 1-800 number and you end up talking or looking for a consumer loan, um, either Alicia or I or one of the 10 others or 8 others will help. And we're glad to sit down, look at one-on-one basis too. We actually have um, financial consultants. I'm sorry, what's the last financial advisors
Yep.
that they're not we have investment people too, but we have people that will actually sit down and work with you on a budget um, and or spending plan as we call it. So feel free to reach out. You can actually make a one-on-one appointment with them either in a branch or over the phone through video. And we want you to be successful. It just helps all of us. So, well, thank you guys all so much. Yes, you guys all have a great night. We really enjoyed it. So
Yep.
thank you for taking the time. I'll keep this up for just a couple minutes here in case you want to hit that QR code or if any questions pop in your mind. But again, reach out to us personally if you want. We don't always have every answer, but we have a lot of good resources here, a lot of good employees that can answer. Or we come across a lot of stuff by trial and error, like, oh, just like that renting question. Oh, that's right. People ask about that, and then we have to do a little research on it. So Good questions. Is that just us now, Alicia?
Oh, no, there's still a
Two
couple.
more? Okay, sure.
Yeah.
I'll keep it up here for just a minute then. Just in time for the wild game. Perfect. Well, it's always takes so long for them to go through all their introductions. And now, like those late games, if they're the second game, they'll wait till the one game's over, for TV,
hmm
especially the basketball games, and they'll be super late. Thank you so much for helping too, Alicia. I appreciate it.
Yeah,
Yeah, I never would be able to keep up with all the everything at once.
it was fun.
It was fun.
Still have one more
Sure.
attendee. I don't see any questions coming in, so I think
Okay, we'll
we can go
probably
ahead
end it
and
here.
close it.
So,
Yep.
yeah, well, you guys have a great night, and I'll see you tomorrow, Alicia, I think.
You will see me tomorrow.
All
Bye,
right,
Brett.
have a good night.
You too. Bye.